Investor's Guide. Thank you so much for tuning in. A quick reminder, of course, that we're about less than a week away from the deadline to file your taxes for the financial year gone by. So it might make sense to put that right on top of your to-do list and focus on that. But over the next half hour, we'll take a look at our stable growth portfolio. Now, remember, this is the portfolio we designed for a 40-year-old. It's an excellent portfolio, and you're really going to enjoy looking at it because it's performed so well over the long term. Also, HDFC Equity Fund, is it the fund that you should be investing in if you're starting a mutual fund portfolio right now? And how do you save capital gains tax on agricultural land? That's coming up later on the show. All right, let me bring in Dhirendra Kumar. Dhirendra, thank you so much for joining us. The deadline to file our taxes is closing in on us. Dhirendra, about a week to go. For our newer, younger viewers, how important is it to make sure that this gets done, it gets done on time, and it gets done properly?
Filing your return accurately is very important. Filing your return on time is just as important. And it's very important for the for the simple reason that your legitimate activity, income, expenses, if not expenses in great detail for salaried people, and your asset accumulation over time. It must be reported and accurately, and don't be careless about it. Because if you're not careful about all your reportings in your annual return, at a future date when you realize some of the gains, there'll be questions and you will have to answer it, and it will be construed as misrepresentation.
All right, so of course, it's important to meticulously pay attention to what you're doing with your taxes. Now, remember, there are several websites that allow you to file your taxes online. But if you have a slightly complicated, tax portfolio in the sense that you're not salaried, you have other income coming in from other places, or you have a complicated asset list, like Dhirendra was saying, of equity or real estate, get the help of a tax professional or a chartered accountant who will help you do it so that it's done right and you don't have trouble in the future, like Dhirendra was pointing out. Dhirendra, it's time for us to look at our stable growth portfolio. I'm extremely proud of this portfolio. I know you are as well. Just to give our viewers a recap, this portfolio was designed for someone in the 40-45 years age bracket. The idea is to give you the growth that equity will give you, while also giving you an easy to manage, tax, effective, and also a stable portfolio that doesn't do too much, volatility and too much up and down in the market. Here's the 4 funds in this portfolio: the Canada Robeco Balanced, HDFC Prudence, ICICI Prudential Balanced Advantage, and the Reliance Regular Savings Balanced Fund. Now, we've been hypothetically investing 10,000 rupees a month in this portfolio, and it's currently valued at 14.44 lakh rupees. It's a total gain of an annualized 14.6%. That's a fantastic result from balanced funds, Dhirendra. What's your advice to anyone in the 40-45 year age bracket who's considering this portfolio right now?
I would say that the appeal of this portfolio is far wider than this age bracket only. Most importantly, anybody getting started who has never experienced equity market, has never invested in stocks ever, or equity fund, and is scared of the the equity market because it is very, very volatile. It goes up and down by 5% sometimes in few days. So for them, this turns out to be a bonanza. This turns out to be a great starting point. The other is tax efficiency. Your 30-35% allocation or investment in fixed income effectively gets the treatment of equity. If you hold your investment for 1 year, all your returns are completely tax-free. So this 14.4%, whatever it be, sometimes it is 15%, sometimes it is 13%. But this 13% return is absolutely tax-free. That actually makes it far more attractive. And most investors who have earned 13-14% have beaten the inflation and fixed income by a wide margin without assuming great risk. Without experiencing great volatility. Most investors are deprived of equity simply because when they start, when you invest lump sum and when you invest in something which is so volatile that you take your money out soon after you invest, never to come back again. Balanced funds help you navigate that.
All right, so remember, balanced funds are tax efficient because even though there is a debt component or like a fixed deposit like component in it, it still gets a complete tax benefit like an equity fund. The second thing to keep in mind about this portfolio, it's only 4 funds, which means that it's easy to manage and you're not doing too much paperwork. You don't have a lot of stuff to track. And finally, it's a stable, steady way to approach the market, especially if you're a first-time investor. A quick recap of the funds in our growth portfolio. Canara Robeco Balanced, HDFC Prudence, ICICI Prudential Balanced Advantage, and of course the Reliance Regular Savings Balanced Funds. If you have questions about it, you know how you can get in touch. Email ID is at the bottom of your screen. I'm glad we're talking about first-time investors because it's time for our financial plan, and this time we're looking at a young first-time investor. So here's the profile today, Dhirendra. 24-year-old woman, first-time equity, first-time mutual fund investors, zero liabilities and dependents, and she wants to know how to get started. Now, AKRITHI has written in, that's her name, and she has a very interesting profile. She has sent us long-term and short-term goals, and this is what I love about it. Her short-term goals, Dhirendra, are 10 years from now. She wants to buy a home of about 50 lakh rupees and a car about 10 lakh rupees. Her long-term goals are 30 years from now. So she's looking at education and the wedding of a child and her retirement, and she sent us her details. But the only thing I'm worried about here with those two goals, considering she's thinking about something that's 10 years away, it's likely that a car that is currently worth the 10 lakh rupee bracket will be worth far more in 10 years' time, given the rate at which automobile prices are increasing in our country. The same for the home that she's considering, that's 50 lakh rupees. Would you like her to, sort of factor in the inflation and the change in prices over 10 years? Or do you think that because she's such a good saver that she'll sort of outrun inflation?
The prices now are, they could be very different. You know, the pace at which car prices have gone up in the last 25 years is very different from the way the home prices have gone up. And they will be very different in the next 10 years. I don't know if, home prices will continue to rise the way they did in the last 10 years. But I'm sure how, the input prices of car will definitely drive, and it will definitely match the inflation. So she should factor that. And mind you, she's a very good saver and she's a very poor investor. And that is something she has to prepare for, because just being a saver is not enough. Unless she's she's a prudent investor, all her goals, despite the saving, will not be achieved nicely.
All right. In fact, this is what we should be looking at right now. If you look at her portfolio, she has the Public Provident Fund. She has 3 different fixed deposits. While, like you said, she's saved a lot of money, it's not very active money. It's not doing a lot for her. She has about a little over 1 lakh rupees in her bank account. She has a post office deposit, and she tells us she has some shares. She's not specified what these shares are. My guess is that she's inherited them or someone has bought them for her, because she doesn't seem like somebody who's actively investing in the stock market. She wants to make her first mutual fund investments of about 15,000 rupees a month. What are the funds she should be using? Should she be staying, like you said earlier on the show, with balanced funds, and in that category, would that be a good way for her to go?
I would think that, the prudent way will be having the essential emergency money in your deposit or your bank account, or, a combination of these two, maybe 50,000, 1 lakh rupee, whatever she visualizes that could be a possible emergency. Beyond that, it should be the other way around. 95% of the money should be in fixed income at her age. She needs to really rethink, otherwise she'll be earning well, she'll be saving conservatively, aggressively, and putting that savings conservatively into these deposits, and she will not eventually be very, very rich.
All right, Dhirendra, what funds would you recommend specifically for her to use? Should I put up just our list of balanced funds? Should she start off with balanced funds then?
Yes, she should start with the balanced fund, and she should go with, the 4 balanced fund, of which 2 are relatively aggressive, the Prudence and the Reliance, balanced. She should consider those 2. And she should also consider, as the money gets out of, as the money in deposits mature, possibly discontinue her PPF, because this is a long-term recurring deposit going to earn fixed income, which is likely to come down over a period of time, and she will be very disciplined with those savings. The return and compounding, and the disciplined investing and compounding over such a long period of time, the accumulation in any market-linked investment will be substantially higher with far lower risk. So she should consider not only for the 15,000 which she wants to invest, but over a period of time, move her money which will be maturing in deposits, as well as other the term deposit, and seriously consider reducing her investment in PPF.
All right. So here's what you do. On your screen right now are the balanced funds that Dhirendra has recommended for you. What you need to do is slowly start developing the appetite to invest in equities. Since you've got the 15,000 rupees set aside, begin by splitting them across these two funds and start making those investments. And as you get more confident, and we're seeing your three fixed deposits, like Dhirendra said, will mature over the next year or so, all of that money should also find its way into these mutual funds, and you should only keep in your fixed deposit what you need for emergencies so that you can break it and use it whenever you need to. If you need anything else, of course, you can feel free to get back in touch with us. Quick takeaways before we go into break. First of all, file your taxes if you haven't done so already. Be really careful and meticulous and get help from a professional when doing so. You don't want that to come back later and haunt you in the future. The other thing to keep in mind is to, not leave all of your money in a fixed deposit. It's sort of like an indoor plant. I mean, it'll be in the house and it's safe, but it's never going to grow into a big, strong tree. In order to do that, you have to take it out and invest it in equity. And finally, if you're a first-time investor, a balanced fund is a good way to go. We're going to take a quick break. We'll come back on the other side. Dhirendra will stay with us. HDFC Equity, is that the fund of the hour? On the other side, don't go anywhere. You're watching Investors Guide. This is the show that will give you all of the advice you need about managing your money for whatever your goal may be, whether it is buying a house or just saving for your retirement or just simply becoming very, very rich. That's a valid goal here on this show. Today we're looking at the HDFC Equity Fund with Dhirendra Kumar. Avan will take you through the latest numbers and then we'll come back and talk about it. Avan.
Thanks, Faye. This week we take a look at a fund that is not a new name for our investors, the HDFC Equity Fund. With over 15,448 crores as assets under management, the fund that used to be a stellar performer once upon a time has slipped in the performance chart in the recent years. Let's take a closer look at its performance over the last 5 years. The red line is the fund and the blue line is the benchmark. You'll see that the fund has been gradually slipping in its performance over the years. In the year 2015, the fund was at its worst with a negative return of -5%. The fund has slipped in its rating to 2 stars on Value Research as well. You'll also notice that while the fund's long-term performance has been marginally better than its benchmark and category, its short-term performance has taken a hit with just a negative 0.6%. In fact, several other funds in the category have given better returns than this fund. So is it time then for you to sell out of this fund? Let's find out. With that, it's back to you, Faye.
All right, Avan, thank you for those details. Dhirendra, HDFC Equity, and the reason why we're bringing it up this week is because we're getting some questions from viewers asking if this is the fund they should be investing in right now, and where you stand on this fund, given the fact that, again, its star rating has slipped so drastically on Value Research. HDFC Equity was a fund that, on this show at least, that qualified for a core holding, something that, could actually be one among 1 or 2 funds in your portfolio. Do you still have that opinion about HDFC Equity?
No, my opinion has changed and it is not as rosy as it was. This has been a fairly disappointing fund in recent years. The complexion has changed, it has turned big, and it has changed its character. It was, nearly 30-40% into mid-cap. It can't afford to have that allocation. So that thing, the whole booster in the fund, where it actually made a name for itself over such a long period of time, that has been marginalized. In 2015, it was among the worst performing fund among multi-caps, which was certainly, this fund took its bet, but it was not expected, and for such a large fund, I think maneuverability is increasingly going to be an issue. And looking at alternatives, now we have far more agile, more efficient, more diverse, insulated from such a style focus, which has proved extremely disappointing.
Then if we talk about the 15,000 crore rupees in this fund as assets under management, this is money that belongs to average investors like those watching our show right now. Would you recommend that they take their money out?
Yeah, I think, the way investors have gradually accumulated their money here, they should gradually take this money out. Recent times, the fund is it has done very well last 6-8 months. And I think, the fund has a strategy. Fund has a strategy which is working or playing out nicely now. So I don't think investors need to really rush out. But looking at, the last 15, 17 years performance and expecting the same from this fund, I think the dynamics has changed, and investors should reconcile with that. Gradually, look elsewhere too.
Give us a couple of names of better options, for investors who come out of this fund right now.
2-3 mainstream funds, multi-cap fund comes to my mind. ICICI Prudential Value Discovery, or Franklin Prima Plus, or Tata Equity Opportunity. They are funds with long enough track record, well rated, done consistently well. So without the constraints which a constraint faced by HDFC Equity. All right,
Dhirendra, finally, your star rating for HDFC Equity?
It is same as it's a below average, turning around, 2-star on a risk adjusted scale. So is my rating.
2 stars for HDFC Equity on Investors Guide, and a sell call on HDFC Equity. That's disappointing. It's rare we get sell calls on this show of funds that we've recommended in the past. On your screen right now are funds that will actually make a better choice in this market right now than HDFC Equity. Let's move on to our next segment. It's called Buy a Home. Priya has written in, Dhirendra, and I love when women investors write in. She says she wants to build a corpus of 2 to 3 crore rupees to buy her second home in Mumbai in the next 2 or 3 years, among other goals, she says. She wants to know if the funds that she's investing in right now are good enough. Now, we must remember that she only has 2 to 3 years. So even if we take the outside limit of 3 years, are these the funds that she should be using? DSP BlackRock Top 100, she's been investing since December 2009. UTI Opportunities, ICICI Prudential Focus Blue Chip, she's been investing since 2012. And Franklin India Blue Chip Fund since November 2012. My question to you is, if she's looking at doing this in the next 2 years, should she now be considering actually a withdrawal stage of this money?
I would like to question, I would like Faye, you to answer this, or at least persuade her that, because you're also the editor of Magic Bricks now, that should one be buying a second house for an income stream? Is it a wise thing to do? And coming back to, the mutual fund she has chosen, yes, it's about time. One should be, one should not be thinking of equity for 2 years, particularly now. And 2 years time frame can be very disappointing for anybody, and one should start gradually pulling out. If all this accumulation so far adds up to down payment, by all means go ahead and pull your money out. It has done very well in recent times. Maybe add your money in an income fund and see if that adds up to your down payment.
All right, to answer Dhirendra's specific question about whether it makes sense for Priya to be using a second home, and I think, Dhirendra, the key to this entire question is the fact that she says she wants to invest in a second home. So this is not a holiday home or a weekend home that she's looking at to buy, recreationally. She actually wants to make an investment into a second piece of property. It's a high ticket size of 2 to 3 crore rupees. She's also written a little further saying, I stopped my mutual fund investments last year due to a change in my employment status. I'll resume it again on a smaller scale. So this is obviously, again, someone who hasn't had a very stable, steady stream of income. She's having to prune and switch her funds and things like that. So here are my reasons, Priya. If you are buying your first home, which you obviously are not, for our viewers who are buying their first home, there is an emotional, sort of investment that we make to own the home that we live in, which I completely understand. But if you're buying your second home as an investment, I must warn you, especially in the city of Mumbai, nobody is expecting the kind of returns that real estate gave us over the last 10 or 20 years. Your money is not going to double and quadruple in the next few years. It's very likely to match a fixed deposit or lower, if at all, give you any returns. And it's going to be very specific to who the developer is, what location you're buying in, and what is the specifications of the home that you're looking at. So if you have 2 to 3 crore rupees, and ideally for a real estate investment, you should have at least 10 or 15 years on your hands, my honest advice would be to consider mutual funds instead, or to consider a broader asset class. Because if you put all of your money into real estate, it's also illiquid, it's difficult to sell, you can't access that money if you need it in a hurry. So I want you to consider all of these things. Most importantly, because you already own one home, there is really no need for you to go out and buy another one. So you're making a purely unemotional investment decision. And that you need to consider liquidity, the tax treatment, and of course how fiddly an investment it is to actually manage. Dhirendra, my recommendation for her would be to not buy a second home right now, especially not in this market. At least we're expecting more pain going forward. Would you agree that she should, if she has this kind of money, she should actually stay in mutual funds?
Yeah, absolutely. You know, given that she's able to save this much, it will be very wise, and you know the return will be much better. It will be liquid, it will be tax efficient, and it will come without any hassle. And also, you know, there's absolutely no need to get into something which requires so much of management or maintenance. So I would say that, you know, I would urge everybody to keep their financial life simple, and more so from today's standpoint. If you are trying to work on building an income stream, the economics doesn't work out, because the rental income yield from property today will be so low that it can't even match a part, you know, it can't even contribute a part of your EMI if you're planning to borrow.
Dhirendra, thank you so much for answering all of our questions and spending time with us this week. We'll come back and talk about your tax. That's on the other side. Don't go anywhere. Welcome back. You're watching Investors Guide. Suresh Surana from RSM Astute Consulting has agreed to answer our tax question. Suresh, Shiv Kumar has written in. He wants to know if MIP funds and the money earned from them is taxable, and what the process is involved with filing taxes. He's running out of time, so we better answer his question quickly.
Yeah, so Mr. Shiv Kumar, as far as the MIP is concerned, which is the monthly income plan, these are debt-oriented units of the mutual funds. Whatever dividend you are getting from these units, that is tax-free. Now, as far as the capital gain at the time of redemption or sale is concerned, if you have been holding it for more than 36 months, then it will be treated as a long-term capital gain, and you will be taxed at a concessional rate of 20%. You will also get the benefit of indexation. In case you are holding it for less than 36 months, then it will be a short-term capital gain and taxed at a normal tax rate. So this is the first part of your question. Now, second part is in respect of exempt income. How do you demonstrate that during the time of filing, and what documentary evidence you need? While filing the form, whether it is ITR 1 or 2A or 2, there is a separate schedule for exempt income called Schedule EA. So you must take care to reflect the exempt income in that particular schedule. You don't have to furnish any documents at the time of filing the return, but you must preserve those documents so that in case the case is selected for scrutiny, or the tax authorities want you to substantiate that, you are able to substantiate that. Of course, there are many types of income like dividend on shares or units of funds, which are by very nature exempt from tax. So it should not be a problem in those cases.
Ayush Gupta has also written in. He wants to know about the extra 50,000 rupee deduction under Section 80CCD. He says his employer contributes the same amount from his salary. He wants to know whether that is tax deductible.
Under Section 80CCD, there are two deductions available. One is under Section 80CCD subsection 1, where the employer is contributing and the total deduction is limited to 10% of the salary. This amount is eligible for deduction within an overall limit of rupees 1.5 lakhs, which also includes the Section 80C limit. So that is one particular thing. There is an additional deduction available under Section 80CCD subsection 1B of rupees 50,000, which if you contribute, that deduction is available over and above the 1.5 lakh rupees which is available. From what you are describing, it appears that your employer has contributed this amount, which is under the Section 80CCD subsection 1, which is a part of the overall deduction of rupees 1.5 lakhs, including Section 80C.
All right, that's a wrap on Investors Guide. Email ID is at the bottom of your screen. Whatever it is you need to do with your money, we're here to help. Feel free to get in touch. Thank you so much for watching.